Welcome back to another episode of Who Charted. I am Dan Russo, Co-CIO here at Potomac, and the theme of today's show is deceptive weakness. We'll get into what that means in a little bit. There is a repeating chart from last week. We've also have some seasonality to introduce, as it's the first trading day of February. So first trading day of the new month. Let's kind of look at some seasonality. But let's start the way that we always do with the S&P 500. And the S&P 500 actually did make a new all-time high last week. All right, basically then finished the week in the middle of the range, still well above that rising 60-week moving average. So from a price trend perspective, if all you did was look at price, things still look okay. Now, obviously, we are big believers in price. We think that price is the most important data point, but it's not the only data point, right? Part of being a tactical manager is looking what's happening in other markets, under the surface of the equity market. So S&P 500, all good, right? Uptrend still intact, made a new high last week. Normally, I would say there's nothing bearish about new all-time highs. And I'm not saying things are bearish here. Remember last week, we started to see some signs of trouble, right? This is more a continuation of that. Not a full-blown falling apart just yet, but things we want to be paying attention to. Now, this is the repeat chart. All right, this is a 5-day moving average of NYSE decliners, and it has been moving up and to the right since the start of 2026. Right? By definition, this entire area inside the box here is an uptrend, higher highs and higher lows. Okay, if you want to take the CMT exam, that is the first thing you will learn when you read the books. At the same time, we continue to see an uptick in new lows on the NYSE. Right now, you can't have a bear market without new lows. We don't have runaway new lows just yet. But again, look at the dynamic that's playing out. Since the start of 2026, up and to the right, up and to the right. Decliners are moving higher. New lows are moving higher. It's all playing out as the S&P 500 traded at an all-time high last week. That is something under the surface that we want to pay attention to. We want to be mindful of that. At the same time, nobody is really paying attention to this. I only saw one or two people talking about it over the weekend. I still like to pay attention to sector work. So while this is not explicitly part of the process at Potomac, I do like to pay attention to what's happening in the consumer staples. Remember, consumer staples are the companies that sell the things you need. No matter what, you need them. Consumer discretionary sells the things you want, right? If we go into a recession, you probably still need to buy toothpaste. You probably still need to buy paper towels. You might trade down, but you need these things, right? So consumer staples as a group tend to do better when people are concerned. Now, price basis, just chopping sideways here. Kind of looks like the chart we've been showing for months of the transports, right? Been going sideways since September. Not a lot to really get excited about. Maybe, we're on the verge of a new high here. That's kind of interesting. Fine. But here's what interests me. Consumer staples relative to the S&P 500. Made a low in November, tested that low to start the year, and is moving higher. The yellow line is the 50-day moving average. Now, that is beginning to turn higher as well. So that's something we really want to pay attention to, okay? We want to pay attention to the fact that the defensive area of the market, I'm going to erase this a little bit here. The defensive area of the market is starting to trade better on a relative basis. That is something you definitely want to pay attention to. And at the same time, I'm going to step aside here on this one. Take a look at February. February, now obviously not quite September, but February is the only other month of the year that since 1950 for the S&P 500 has been down on average, right? Think about what plays out here. We get November, monster. We get December, really good, okay? We get January, really good. Arguably a 3-month stretch of strength on average for the S&P 500. February takes a breather, okay? So let's recap. Decliners are starting to move higher, okay? New lows are starting to move higher. one of the more defensive areas of the market is starting to outperform on a relative basis. You're not paying attention to that because consumer staples are about 5.5% of the S&P 500. All of this is playing out as we move into one of only 2 months during the year that on average has been down since 1950. And all of that is playing out, right, while everybody is focused on this. All right? Silver spot, gold spot, 50-day moving averages. Everybody's paying attention. Sure, it's all over the news. Everybody's talking about it. You have these two metals that have been around forever, essentially trading like meme stocks from 2021, right? Getting really extended above their 50-day moving averages and then pulling back. Now, there's a lot at play here as it relates to futures, right? Margin requirements can change. These are crowded trades that are correcting. Everybody is talking about it, all right? And that is what's top of mind right now. But if you're an equity investor, you probably want to be paying attention to some of the deceptive weakness that's playing out under the surface. Is it a sell signal at this point? No. Is it something you need to have on your radar? Absolutely. So thank you once again for taking time to listen to what I have to say. Hope everybody had a great weekend and has a great start to February. We'll be back with you next week.